For our next section, we're going to introduce accounting fundamentals. Most business owners see accounting as a math course and are quick to delegate the responsibility of preparing their documents off to another or avoid reviewing them altogether. While accounting does involve math, the math is relatively simple. Some addition, there's some subtraction, and on occasion, division and multiplication. Common emotional responses when reviewing business financial reports are these: anxiety, often self-doubt. I've even had business owners say that their mind seems to shut down. They are convinced that they can't perform math, therefore they can't read their financials. They often say, I don't look at my books. I just give the docs to the accountant. They tell me they're done, and I hand them off to the IRS, and I await the refund. Before proceeding, we must address this dilemma, a dilemma that consists of a fear or an uncertainty around using these statements to help the business owner become better at decision-making, or to use these documents to see the future in a more informed way. With the vast variety of businesses, those that I've already talked about, services, retailers, manufacturers, we must ask, how can stakeholders and owners fairly evaluate the health of a business? How is that done? It is done with the use of a common measurement tool called accounting. Accountants have provided a method that establishes a standard basis for all companies or not-for-profits to use. By assigning each investment made within each business to a classification, we talked about investments earlier. We said they're short-term and they're long-term. The business owner, creditor, and investor can quickly assess how well a business is performing and also identify areas where improvements can be made, thus helping the business achieve greater profitability. Let's look a little bit deeper. What have accountants created for us? They've created 5 classifications. The first, assets. The second, liabilities. The third, equity. The fourth, revenues. The fifth one, expenses. Now, it's important for us to understand what goes into each one of these classifications. Let's start with the first easy definition for each one. Assets. These are items that we own, OWN. So what that means, these are items that we either control or we own right out, meaning we own 100% of it. These are items that we use in order to generate revenue, in order to service our clients and our customers. So what we mean by control, we mean simply, I have a lease. So when I sign a lease for a space for my restaurant, I now control that space. Since I control that space, I can then set up my restaurant and I can now service my customers. So it's either control or it's an actual purchase that represents an asset. Liabilities. These are the dollars that I owe, OWE, that I owe to maybe my business partner if they lent me the money, or a family member. Money that I owe to creditors such as bankers. Equity. Equity represents what I've contributed to the business. Remember we were talking about that core investment? Equity represents that, the money that I put into the business to get it started. It also represents one other item that people seldom talk about. It represents the lifeblood of the business, which is profitability. So each year that I am profitable, I add that number to the next number to the next number for each year. And that becomes what we call a retained earnings. I like to reflect that my business has been profitable for as long as the business has been up and running. And that number, retained earnings, which we'll talk about later, represents that. It represents that my business has been profitable over time. So equity is representing my contribution, both financially, money I put in when I started the business, and also my contribution as a manager of the business. I've been managing the business profitably, and I'm trying to document that for you, investor. I'm trying to document that for you, creditor. Next, revenue. This is an important line item here. This represents the money that I have earned. I've earned from the sale of either a good or a service. The key is I've earned it. So I've made it available for sale. People have compensated me by paying the price that I've charged, and now I'm benefiting from that sale. Last but not least, we're looking at expenses. Expenses represent the outlay. This is money that is being issued out of the business to pay for supplies, pay creditors, so on and so on. All right. I'm going to go even further with a couple of more definitions. I've talked about assets, I've talked about liabilities, I've introduced revenues and expenses. I'm going to give you a couple of more that you need to know too. One is cash. What does cash represent to an accountant? Cash represents what we call the money that you have in the bank. It's the real money sitting in your checking and savings account. So that is something that you want to monitor. Now, of course, I know you're monitoring it closely, but when we're talking to our creditors and our investors, they do want to know that you do have money in the bank, and hopefully you have money in the bank that also sits in what we like to call a reserve account. That's your rainy day fund. We also have another term, accounts receivable. So if you're a retailer, you need to understand accounts receivable represents the monies that you are owed by your customers. So you've offered your customers credit. You sold them an item. They have yet to pay you. They paid you with a credit card, or you just gave them pure credit. You said, you can pay me in 30 days. While you wait for that money to come in, it is considered an accounts receivable, monies that you will eventually receive. This is an account that you got to pay close attention to, because you want to make sure that if you offered your client credit, and that credit was for a finite amount of time, 30 days, 45 days, you want to make sure that they pay you in 30 days or 45 days. You want to make sure they don't extend past that period. So this is a line item in your records that you want to pay close attention to. Inventory. We mentioned inventory earlier, but inventory is unique to retailers. It represents the money that you have spent to bring items into your place of business, items that you have an intended purpose, and that intended purpose is to sell it to a customer. So inventory is another important line item that you have to pay close attention to, because you don't want to buy too much inventory, which means that you have inventory that's sitting on the shelf and is not moving. Because for every dollar that's not being recovered, meaning that people are buying, that's dollars that you no longer have use of, and that can hurt your business long term. Gross fixed assets. Oh my God, what does that mean? These are items that are long-term assets. These are the items I mentioned earlier, such as vehicles, land, building, equipment. These are vital to many businesses. Maybe for some service businesses, you don't have all these things. You just maybe have a computer. You have a computer, you have a desk, and that's it. But if I'm a retailer or if I'm a manufacturing company, then I do have these items. I have fixtures, and I have furniture, and I have all these other items, land and equipment, and a building that I own. So I need to keep track of these items, and I need to keep track of depreciation on these items. And so my financial records will account for those things. It accounts for the purchase price of the items, and it also accounts for the use of those items, because every day I use them, they start to lose value. Accounts payable. Accounts payable is one of those items that represents my management practice. And what does it mean? The word payable means that I need to pay someone. I owe someone. How does it represent my management practice? It represents the money I owe to my suppliers. It's the promise I'm making to my suppliers. So if I promise I will pay my suppliers in 30 days, my supplier is waiting for that payment, they're looking for that payment to occur within 30 days, my reputation will depend on me making that payment on time. So accounts payable is really a reflection of my reputation and my reputation with my suppliers. So once I commit to make a payment to someone and that payment is going to be delayed, by 30 days, because that's the arrangement I have with that supplier, I need to make sure that I have the monies available in order to make that payment. So accounts payable is one of those items I need to track as well to make sure that I'm paying on time so I can maintain a healthy relationship with my suppliers. And lastly, we have a term called long-term liabilities. So we have these payments I'm making to suppliers, and these are typically going to be made within a year. I may also have what we call long-term liabilities. These are items that I'm going to be paying on for a period of time greater than 1 year. And I'm sure you already know what those are. If I buy a vehicle, I'm usually going to take 5 years, 6 years to pay it off. If I'm buying a piece of property, I'm going to take 20, 30 years to pay it off. So those are all considered long-term liabilities. Again, it just reflects an obligation that I have to another party. So accounts payable reflects an obligation that is short-term in nature. I'm going to pay within a year. Long-term liabilities, these are going to be payments I'm making throughout the year, but they will extend beyond a year. There's one last definition I have for you, and this is a critical definition. It's one that accountants and bankers rely on. It's called the accounting equation. Very simple equation. It states that your total assets are equal to your total liabilities and your equity. So I'll say that again. Your total assets are equal to your total liabilities plus your equity. So what are we saying in this equation? We're saying that any business that's out there is going to have a set of assets. And what the investor and the creditor are going to ask is, how did you pay for those assets? Did you pay for those assets with debt or a liability? Or did you pay for those assets from effort that you've made in running the business? In this case, that effort shows up as profitability. So I can use monies from an investor. I can use monies from a creditor to buy assets. And depending on whose money I'm using, it will dictate how much credit I have to give to that person. And credit in this case means how much almost ownership or how much influence I have to give to that person. So let's start off with liabilities. If I use debt to pay for the asset, then I owe money to the bank. And the bank is also going to charge me interest. So that relationship is going to hinge on me making my principal payments and making my interest payments. As long as I make those on time, the bank is going to be very happy with me. But what if the money comes from an investor? That money typically shows up as equity. That investor is going to ask for a partial ownership in the business. They're going to become my partner in the business. And therefore, I'm going to involve them in many of the management decisions that I'm going to have to make in the business. So that's what I mean by their influence. Creditors, bankers are not going to get involved in the day-to-day, but they are interested in your ability to pay them back on time. Investors are going to get involved in the day-to-day. This equation gives me a sense of who is involved in running your business. If you use a lot of debt, a lot of liabilities, then I know the bank is going to be involved. They're going to have an influence in how you run your business. If most of the money is coming from you, is coming from the business in the form of profitability, then I know you are the sole influencer in the business. If money is coming in from the business and from you and from an outside investor, then I know there's going to be an outside investor who has influence in the running of your business. So the equation gives the outside world an insight into who has an impact or an influence in the operations of your business. And it also shows where the money is coming from in order to pay for the assets that you are using for the business. So there's a lot included in the equation. But you need to understand that it does have value, meaning you do need to understand what it is saying to the outside world, so that if you're asked questions about, hey, are you using bank funding? Is the bank involved in some of your decisions? Are you paying the bank on time, paying back your principal, paying back your interest? You are prepared for those questions, and you can answer those questions confidently. If they see more money coming in from equity, they'll ask you about how you run the business to generate profit, and you'll be able to answer those questions. Or they may ask questions about who are your investors and how are your investors involved in your business. And once again, you'll be able to answer that question confidently because you understand the impact of this equation on communicating to the outside world how you actually fund your business.